December 2001, Houston. Employees walk out of a 50-story glass tower carrying cardboard boxes, framed photos, coffee mugs, the small debris of careers that ended overnight. Weeks earlier, the company inside that building was worth $80 billion. It employed more than 20,000 people and had been named America's most innovative company 6 years running by Fortune magazine. Its stock had traded above $90 a share. Now that stock is worth 12 cents. Pensions built entirely on company shares are gone. The retirement accounts gone with them. What actually happened inside those walls wasn't innovation at all. It was an idea so simple and so corrosive that it eventually poisoned an entire accounting profession. But to understand how it all fell apart, you have to go back to the beginning. Enron was born in 1985, the product of a merger between two unremarkable natural gas pipeline companies, Houston Natural Gas and Internorth. It was, at first, exactly what it looked like, a company that moved gas through steel pipes across the country and earned steady, boring, regulated money doing it. Kenneth Lay, a former economist with a talent for navigating Washington, ran it from a new headquarters in Houston, Texas. For its first several years, Enron looked like hundreds of other energy companies in the American Southwest. What changed everything was deregulation and one hire. In the early 1990s, Lay brought in Jeffrey Skilling, a sharp, ambitious consultant from McKinsey with a simple insight. Pipelines were commodities, but the right to buy and sell energy, contracts, futures, risk itself, could be turned into something far more profitable. Skilling didn't want Enron to just carry gas. He wanted Enron to trade it, the way Wall Street traded stocks and bonds. He pitched a new identity for the company, not a utility, but a market maker for energy. To make that model work, Skilling needed a different way to keep the books. Traditional accounting recognized revenue when cash actually changed hands. But Enron's new business was built on long-term energy contracts running years into the future. A power supply deal signed today might not pay out fully for a decade. Skilling wanted to book the projected value of those contracts as profit immediately, the moment the ink dried, based on Enron's own estimate of what they'd eventually be worth. In 1992, the SEC approved this approach, known as mark-to-market accounting, for Enron's use. On paper, this was a legitimate accounting method, already used elsewhere in finance. In Enron's hands, it became something closer to a machine for manufacturing profit out of forecasts. If a deal looked good on a spreadsheet, Enron could report the imagined future earnings today, regardless of whether the gas ever flowed or the cash ever arrived. The riskier and more complex the trade, the more room there was to be optimistic about its value. And Enron's traders became very, very optimistic. The results, at least on the income statement, were spectacular. Enron expanded from pipelines into trading electricity, weather derivatives, broadband capacity, even water rights. It built power plants overseas. It positioned itself as a new kind of company entirely, not an industrial relic, but a sleek, intellectual, Wall Street-style operation stocked with Ivy League MBAs. Fortune magazine agreed with the branding, naming Enron America's most innovative company, and then naming it again, year after year, 6 times in a row. By the end of the 1990s, Enron's stock was one of the most admired in the country. Analysts loved it. Business schools studied it. At its peak, the company was valued at roughly $80 billion, one of the largest corporations in the United States. From the outside, it looked like the future of American business had arrived early, and it was headquartered in Houston. Mark-to-market accounting solved one problem for Enron and created another. If you book tomorrow's imagined profits today, you eventually have to make good on that promise. And if the deal turns out to be worse than projected, or takes longer to pay off than expected, the gap between the fictional profit already reported and the real cash still missing has to go somewhere. It cannot simply vanish from the books. It has to be hidden. That job fell to Chief Financial Officer Andrew Fastow. Fasto built a sprawling network of special-purpose entities, technically separate companies, often with strange, forgettable names, that existed primarily on paper. Their official purpose was to take on risk and debt that Enron wanted off its own balance sheet. Their actual purpose was to let Enron look far healthier than it was. Underperforming assets, mounting losses, and enormous piles of debt were quietly transferred into these entities that Enron itself secretly controlled. Enron's balance sheet stayed clean. Its earnings kept climbing. Wall Street kept cheering. What made this scheme so durable for so long was that almost nobody outside a small circle understood it well enough to question it. The structures were deliberately, dazzlingly complicated. Layers of partnerships and shell companies with interlocking guarantees, designed less to make financial sense than to make outside scrutiny exhausting. Analysts who asked probing questions on earnings calls were sometimes waved off or ridiculed. The company's swagger became part of its defense. If you didn't understand Enron's business, that was a sign of your limitation, not theirs. Inside the building, a culture took hold that made all of this easier to sustain. Enron ranked employees against each other in a brutal internal review process, and the harshest graded staff were pushed out every year, regardless of how the company as a whole was performing. Aggressive deal-making was rewarded and celebrated. Caution was treated as a career risk. Executives who hit their targets got rich, sometimes from bonuses tied directly to the very earnings estimates that mark-to-market accounting let them invent. The incentives all pointed the same direction: report a bigger number this quarter and worry about whether it's real later. Outside the building, almost nothing suggested trouble. The stock kept climbing through 2000 and into early 2001. Enron's credit rating stayed healthy. Its executives appeared on magazine covers and business news shows, explaining in confident and faintly condescending tones a business model that was, by design, very hard for outsiders to fully verify. The cracks were already there, spreading quietly through a foundation built out of paper. Nobody with the power to stop it wanted to be the one who asked the obvious question. The unraveling started, as it often does, with a question nobody could quite answer. Through 2001, journalists and short sellers began asking a basic thing: how exactly does Enron make its money? The company's own executives struggled to give a clear answer, and that struggle became public. In August, Jeffrey Skilling abruptly resigned as chief executive after only a few months in the role, citing personal reasons. The timing unsettled people who had trusted the company's momentum without question. Then the losses that had been hidden in Fasto's off-books entities started coming due, and there was no longer enough room to hide them. Enron was forced to admit that some of those partnerships weren't as independent as they'd claimed, and that billions of dollars in debt Enron had kept off its own balance sheet actually belonged to Enron after all. In October 2001, the company restated years of earnings, wiping out hundreds of millions of dollars in previously reported profit in a single announcement. The Securities and Exchange Commission opened a formal investigation. Once the restatement became public, the collapse accelerated with brutal speed. Enron's business model depended entirely on trust. Trading partners extended it credit and signed long-term contracts based on confidence in its financial strength. That confidence evaporated almost overnight. Credit rating agencies downgraded Enron's debt to junk status. Trading partners refused to do business with a company that might not exist in a few months. The stock, which had traded above $90 a share at its peak, went into free fall, sliding through the double digits, then the single digits, then down to pennies, ultimately bottoming out at around 12 cents a share. A proposed rescue merger with a rival energy company, Dinnigy, collapsed under the weight of what auditors kept discovering. There was, in the end, no buyer willing to inherit the mess. On December 2, 2001, Enron filed for Chapter 11 bankruptcy, At the time, the largest corporate bankruptcy in American history. More than 20,000 employees lost their jobs in the aftermath. Many of them had their retirement savings tied up in company stock inside 401k plans, and that stock was now worthless. Life savings built over decades disappeared in weeks. The damage didn't stop at Enron's own employees. Arthur Andersen, one of the largest accounting firms in the world and Enron's outside auditor, had signed off on years of these financial statements. As investigators closed in, Andersen employees shredded relevant documents. In 2002, the firm was convicted of obstruction of justice. A company with tens of thousands of employees and a century of reputation collapsed within months, taken down by the same fraud it was supposed to have caught. The numbers took years to fully settle. 20,000 jobs, gone in a single filing. Billions of dollars in retirement savings, wiped out because employees had been encouraged to hold Enron stock inside their pension plans, stock that management had kept selling even as insiders knew what was coming. Kenneth Lay was convicted of fraud and conspiracy in 2006 and died before he was sentenced. Jeffrey Skilling was convicted and served more than a decade in prison. Andrew Fastow, the architect of the hidden entities, pleaded guilty and cooperated with prosecutors, serving several years himself. Arthur Andersen, once one of the 5 largest accounting firms on Earth, effectively ceased to exist as a business. Its conviction later narrowly overturned on appeal, a legal footnote that arrived long after the firm's reputation, its clients, and its tens of thousands of jobs were already gone. Washington responded the way it usually does after a disaster this large and this public, with new law. The Sarbanes-Oxley Act, passed in 2002, rewrote the rules of American corporate accounting, tighter controls, personal criminal liability for executives who signed off on false statements, new restrictions on the relationship between companies and their auditors. It became the regulatory scar tissue of the entire scandal, a permanent reminder written into federal law. What makes Enron endure as a cautionary tale isn't really the size of the number, $80 billion evaporating, though that number still stuns. It's the method. Enron didn't get caught printing counterfeit money or robbing a vault. It got caught doing something more unsettling, using a legal accounting technique approved by regulators and pushing it until the gap between the story on the earnings report and the truth in the real world became a chasm nobody could paper over anymore. The most innovative company in America, 6 years running, turned out to be innovating mainly in the art of describing reality the way it wished reality would turn out. Eventually, reality sent the bill, and the bill came due for everyone who had trusted the numbers on the page.